Tax Tuesday, where you get a little bit of tax information to help you with your business tax strategy and to help you speak more intelligently with your tax professional. My name is Roderick Robeson. I am a Texas certified public accountant, and today we're going to talk about S Corps, the mighty S corporation. Why am I talking about S corporations? Well, I've seen a lot of advertising around S corporations, and they treat S corporations as if it is the holy grail of tax entities. Now, don't get me wrong, S corporations, they're excellent forms of tax entities, but there's a lot of things you need to know about an S corporation before you decide to elect to be treated as an S corporation. Things that I don't hear in these advertisings are things that I call the traps, the S corp traps. And there's 6 things that I want you to understand about S corporations before you decide to elect to be taxed as an S corporation. And these are things you need to talk about with your tax professional if they are hard selling you on the S corp. So the first thing we need to talk about is federal tax versus state tax. Federal tax versus state tax. Why is that important? Because the entity structure of a business is usually defined by state law, not by federal law. The S election or a C election is in federal law. So in some states, like in Texas, there is no S corporation. You either are a for-profit corporation or you're not. But in the state of, let's say, California, there is a such thing as an S corporation at a state level. But the S corp election is a federal level. So the implications of taxes for your entity at the federal and state level are things that need to be considered if you decide to elect to be treated as an S corporation. The next thing you need to know or understand is basis. Your S corporation is something you need to have basis in. What is basis? The easiest way to explain it is the cost that you pay or the cost that you invest in the S corporation. For example, if you bought Apple stock for $100, then your basis in Apple stock would be $100. If your basis in your S corporation goes below zero, there are a whole set of consequences that need to be considered when that happens, especially prior to filing your tax return. And that's something that I don't see or hear talked about when the S election is considered. So basis is what you want to understand about your S corporation. The next thing is allocation rules. With the S corporation, they have very strict rules on how you allocate income and profits. Whereas in, let's say, a partnership, you have a few looser rules on how you're able to allocate those to the equity owners or partners within that organization. So S corps will restrict some of your allocation rules, and that's something you may need to know depending on your specific tax profile. Next, owner types. S corporations will limit not only the number of owners you can have in it, but the types of owners. Partnerships, corporations, and non-resident aliens cannot be shareholders in S corporations. So if you want any of those entities or individuals to be owners in your S corp, you can't even use the S corporation as a tax entity. Then there's a thing that I call the 2% shareholder duality. What does that mean? You're a shareholder and you're an employee. And in certain circumstances, the tax benefits can be advantageous or disadvantageous to you. For example, fringe benefits in an S corporation, if you are a 2% owner, they're taxable to you as the shareholder. Whereas in a C corp, they're not taxable and they're deductible to the C corp. And so there are other little rules like that with the S corporation when you are a 2% shareholder. There's this duality between you as a shareholder and an employee, and those things will impact your taxes. Last but definitely not least is reasonable compensation. Reasonable compensation. I'm going to give you the IRS definition of reasonable compensation, and it is reasonable compensation is the value that would ordinarily be paid for the services by like enterprises under like circumstances. And here's the kicker. Reasonable compensation is determined based on all the facts and circumstances. So what does that mean? That means the IRS is saying, we don't know what it is, but when we see it, we'll let you know, which also means there is no specific algebraic mathematical formula for what reasonable compensation is. So when you hear people say 20% rule, 60-40, 75% rule, they're kind of making these things up. Reasonable compensation is determined by facts and circumstances, and there are a lot of resources that you can look at to determine reasonable compensation. The best place to look is court cases, and you will constantly hear me say that related to taxes. The tax court cases is where you want to go to understand how the IRS and the courts will rule related to any situation related to taxes. So there they are, the S corporation traps, or really they're just things you need to know about an S corp before you decide to get one. So S corporations are great. They are great entities, but you need to have all the information before you decide to have your entity elected as an S corp. So as I always say, do not let perfect be the enemy of good. It is always better to take action than to not. And until next time, peace.